Hello everyone, this is Dr. Mihir Shah once again with another video. In this video, we are going to have one last quick revision based on the topic ratio analysis under the subject wealth management. Again, a very important video for all the TYBMS Sem students. So, we are going to take a quick last minute revision on ratio analysis. What are the most important ratios that you need to cover up? And thereafter, we will be taking up one problem sum just to understand few ratios, how to solve it. Okay. Chalo, let us first note down important 10 to 12 ratios which are required to be learned by all. Okay, so number one, we have current ratio. Current ratio in simple term is current asset upon current liability. So all your current assets upon all your current liability. Second, quick ratio. It is also known as liquid ratio. It is also known as acid test ratio. So remember, quick ratio has three names: quick ratio, liquid ratio, and acid test ratio. Okay, the formula is basically you take all the current asset except stock and prepaid expenses. So if you already have found out current asset, then it will be current asset minus stock minus all your prepaid expenses, and current liability the quick liability will be nothing but current liability minus your bank overdraft. So basically quick ratio is nothing but quick current asset upon quick current liability. So from current asset, when you minus stock and prepaid, or if you do not take stock and prepaid at all, then all the current asset which are pending is nothing but quick current asset. Same way, if you discard bank overdraft, whatever is pending is current or quick current liability. Okay, so quick ratio is quick current asset upon quick current liability. Next, debt equity ratio formula is debt fund upon equity plus reserve and surplus less fictitious. So that's basically equity fund. Okay, that is equity plus reserve and surplus less fictitious. Okay, you all can note down this once. Okay, next, capital gearing ratio formula is debt fund plus preference share capital upon equity plus reserves and surplus less fictitious. Fifth is debtors turnover, that is credit sales upon debtors plus bill receivable. Then we have GP ratio, that is gross profit upon sale into 100. Remember, if they are giving you any income statement and if they ask you to find any ratio, it is always upon sales into 100. Okay. So these are the next three ratios. You can note it down. Okay, next we have net profit ratio. So that's nothing but net profit after tax or net profit upon sales into 100. Stock turnover ratio is COGS, that is cost of goods sold upon average stock, that is opening plus closing divided by 2. Next is proprietary ratio, that is shareholders fund, that is equity plus reserve and surplus less fictitious plus the preference capital upon total asset, which is fixed asset plus current asset plus investment into 100. Okay, you all can note down these are the next three. Okay, and these are the last set of ratio which you need to cover up. Earning per share, that is net profit after tax minus preference dividend upon number of equity shares. Next, dividend payout ratio is dividend per share upon equity earning per share into 100. PE, that is price earning ratio, is market price upon earning per share. And last, fixed asset turnover ratio, that is net sales upon total assets. Okay, you all can note down these ratios. Okay, now we will take a one problem sum to understand few ratios, not all, but at least few ratios, how to get those answers. Okay, following is the summarized balance sheet of Staff Product Limited as on 31st March 2014. The liabilities are given: equity share, preference share, security premium, debentures, profit and loss account, sundry creditors, bank overdraft, provision for tax, proposed dividend. And on the asset side, they're giving you fixed asset, investment, stock, debtors, prepaid expenses, advance income tax, cash, share issue expenses, preliminary expenses. All these liabilities and assets are given to us, and they ask us to find four ratios: current ratio, liquid ratio, debt equity ratio, and capital gearing ratio. Okay, first is current ratio. Current ratio का formula is current asset upon current liability. Now current asset में what all things will appear? So chalo, we'll mark that. So we have stock, we have debtors, we have prepaid expense, we have advance income tax, we have cash and bank balance. And under current liability we have creditors, bank overdraft, provision for tax, and proposed dividend. So we've taken down, we noted down that we taken the values, we got the total 15,30,000 upon 9,55,000. We divided, we got the value as 1.60. Okay, so you can note down that. Okay, second, liquid ratio. Liquid ratio, we remember the formula was quick current asset upon quick current liability, or it is also nothing but current asset minus stock and prepaid, and current liability is and quick current liability is current liability minus bank overdraft. Now since we have already found the totals of current assets and current liability in the previous ratio, we can directly take that value and minus all our stocks and prepaid. So we have stock, prepaid expenses, and advance income tax. That's also a prepaid amount which has been paid, upon current liability, which we have already found, minus bank overdraft, which is 3,95,000. We got 5,62,000 divided by 5,60,000. We divided, we got 1.003 approximately. Okay, so that was the second ratio. You can note it down. Okay, next, third, debt equity ratio. Formula is debt upon equity plus reserve and surplus less fictitious. Now debt mein there is debentures, and under equity we have equity share of 5 lakhs, and reserve and surplus mein we have security premium and profit and loss less fictitious asset, which is 40,000. Okay, so 7,50,000 upon 5,25,000, 7,40,000 less 40,000, that's the total of fictitious assets. So we got 7,50,000 upon 12,25,000 divided, we got the value as 0.61. Okay, so you can note down that. Okay, and then last one, we have capital gearing ratio. Formula is debt upon preference share capital upon debt plus preference share capital upon equity plus reserve and surplus less fictitious assets. So let us see for debt and preference share. Debt is 7,50,000, preference share is 3 lakh. So that's our numerator, 7,50,000 and 3 lakh. Bottom mein we have equity share capital, which is 5 lakh. Reserve and surplus, which is 25,000 and 7,40,000, and fictitious asset, which was less 40,000, which we had even solved earlier, which came to 12,25,000. So 10,50,000 divided by 12,25,000, we get the answer as 0.86. Okay, so that was the fourth ratio that they had asked. So you can note down once. Okay, So I hope this was a small revision based on ratio. The major reason was to just understand what are the most important ratios that you need to cover up. Okay, and how you need to just solve the sum if you get similar question based on balance sheet ratios. Okay. Chalo, I hope everyone have understood that. With that, we will be ending this video here. Thank you.